Jumbo family, this is Olu Kuhn, your trusted advisor. We're here today going over an investment opportunity, the Southby Syndication. So going forward, this video and all documents are informational purposes only. It does not constitute an offer to sell or solicit of an offer to purchase any securities. Please review the complete investment documentation for the detailed terms and conditions. And that's how you can get more info on our private placement memoranda and our prospectus. Um, Email us at Akali Acquisitions, ALKAALI at QUISITIONS @gmail.com. We're going to hop right into the Southby syndication. This is our pitch deck and our marketing video. This is an exclusive syndication opportunity, the Southby Townhomes in Omaha, Nebraska. This is a fiveplex. There are five townhomes, so this is a fiveplex. So we're just going to play the video for you, which has offering memoranda. All right. So that was the Southby marketing video. Now, one thing about this property is that what they were asking is 2.1 million. We do not have it under management right now. However, just negotiating and speaking with the broker, we talked them down to 1.85 or 1,850,000. When you look on the LoopNet site, you're able to see the listing. It's actually listed at 1,900,000. Um, and we, through conversations with Brock, have we could get them to go down to 1,750,000. So this is one of the reasons why you would want to partner with us with this is that without us, you'll be paying above market prices for this property. We're going to take advantage of something. It's a value add. The plan is to purchase it for 1.75 and then sell it for 2,500,000. Uh, and we'll explain all that a little later, but let's go into some of the pitch. Now, this is the opportunity. So, what is the problem we're solving? That is, novice real estate investors struggle to find commercial properties that offer steady income, growth potential, and expert management. This challenge leaves many missing out on lucrative opportunities and settling for subpar investments. Again, if you're using sites like LoopNet, MLS, 10X, you have to understand that a lot of these deals have already been passed over by institutional investors and the brokers' top picks because most of these are above market deals. They're not good deals because discount. People want things at a discount. People want deals. Uh, one of the things you'll be leveraging with us is our relationship with the brokers and developing relationship with the brokers because we're serious about this. We have big goals of acquiring a REIT, but we can talk about that later. But our personable, our personality, that is one of the reasons why the brokers are working with us, and willing to from 2.1 million to 1.85, and I know I can talk them to 175, you know. Uh, so here are solutions for the problem we're solving. Um, One is going to be predictable cash flow. The property is already bringing in money. It's 5 units. 4 out of the 5 units are being leased. We have 2 units that are going to be available in 2025. We have people lined up who are interested in taking those units, and then we have well, three. There's one available unit. We have someone lined up for that one as well, paying market price for that. Um, so predictable cash flow, and then we're going to have an 8% preferred return distributed annually. There's attractive upside. One again, the plan is to purchase this property for $1,750,000 and sell it for $2,500,000. And then there's an equity split on profits after preferred returns. It's a 90% equity split. It's a 90-10 split. The limited partners will get 90% of the profits, and then the general partner will get 10%, 90-10 split. And then professional management. Uh, we are planning on using the current management company access to keep the property running. Take it out of our hands and have it managed by people who do this, professional property managers. Now, our target market is the Nebraska small business community. In our marketing plan, we're using different magazines and outlets to showcase the investment opportunity. Uh, uh, Raise capital. It's a platform we'll be using to raise the capital for the investment. Uh, they're partnered with over 300 accredited investors that are always looking for a good deal. It will be a small expense, but the expense is worth it. Since we're doing general marketing and solicitation, we're only targeting accredited investors. Um, We could talk a little later on what that is. Uh, we're going to look for accredited Nebraska real estate investors. We plan on holding events where we can pitch the ideas in small meetings and gatherings with real estate investors to pitch the idea, get some more information, make sure that they are accredited. Uh, we're going to focus because a lot of what we do is geared towards redistributing American investment dollars to building the African economic ecosystem. Uh, and those who do have money, part of our target audience, are people who are formerly military. And this is, well, really, if we are looking at filing with the SEC under a different rule. The SEC is the people who regulate financial instruments, securities. The SEC is the Securities Exchange Council. Now, when we file, the rules really are around how we are to market, gather information, things like that. And so some of the rules, if we file one way, we could reach 35 people who are not accredited. They have to be sophisticated. We have to take steps to make sure that they know what they're getting into and disclose, a lot of information on the investment. However, that will allow us to work with our goals, but then also medical professionals and what was not in here, medical professionals and like financial advisors and wealth management people who have a Series 7, Series 65, things of that nature. They're also considered accredited investors, but though that's the target audience because it's the population that has the funds. It's the population that would more likely be accredited investors. Now, our competitors, you want to know who else could you give your money to as opposed to us. Respectfully, we'll put it out there. There's nothing wrong with that. There's nothing wrong with healthy competition. So we have institutional investors. Those are like the Charles Schwab's, the Fidelities, the Acorns, wherever you're placing your money to purchase stocks or bonds. We have 401ks and IRAs, people's retirement accounts, mutual funds. You're putting your money, investment dollars towards those things. Then you have local small businesses. Some of us do either shop or with small businesses, give some type of funds to small businesses. Now, how our solutions are better, one, as opposed to putting your money in stocks and bonds, this is a partnership. You will be a limited partner, meaning you'd have limited liability to the investment. You're not going to pay any debts in the event that, all things go wrong. There's a 90% ownership. So you own 90% of the profits. 90% of the profits from the property is sold. Uh, again, with the 401k, same thing. Profits are distributed 90% to the limited partners. That is something we want to push. We want this to benefit our investors more than us. And then, as opposed to investing in your local small business, shopping block, whatever you do, you will receive a preferred annual return. But we'll explain a little bit what more that is later. But 8% return, 8% return. Keep that in mind. 8% on net profits goes to you before anyone else gets paid. We'll go into that later. This is the funding needed. This is the funding needed. $2 million. Again, we are planning on purchasing the property for 1.75 million, $1,750,000. Now, this is a value add property. As you've seen in the video, as we were going downstairs, we touched on the basements. All of the basements are unfinished. Again, these are 5 basements. Now, capex and closing costs, we're just estimating $135,000. Well, until we have the property under management or the phase of doing due diligence, we are not able to get our contractors there to give us an estimate on what it's going to cost to finish these basements. So we left that there. It should be drastically cheaper. But then any other expenditures that may come up, and making sure that we do have funds to fix any problems that may arise while operating the property. So it is covering closing costs. So that's 135,000. Marketing and capital raising, 15,000. Now, for the platform, raises.com is $6,000. One, what they do is make sure that we're SEC compliant. They draft up the paperwork for our investors. Uh, and they also raise the funds for us. So that's a big. They raise the funds with the accredited investors. It takes a lot of pressure off of us. The other $6,000, $7,000, well, $6,000. There is one platform we looked at due to the platform not aligning with our overall objectives. However, we're not going with them, but it's a platform for us to host our deals. It has an investor portal for the investors to set up their bank information, view the deal, uh, uh, do your soft commits, and then when we're ready, you can fund your investment. It'll allow you to, receive distributions, tax information, the whole nine, and that's $6,000. So it could be 6 to 7 depending on the platform. The ones that we have viewed are roughly 6,000. We're looking at Juniper. That's the one we want to go with, but there are other really good platforms that we still will check out. And then for us, we're putting the deal together, making sure that all of our investors are taken care of. We want a acquisition fee of $100,000. So altogether, that's the funding needed, which comes to 2 million, and then we will be selling the property for 2,500,000 within 5 years. The plan is 5 years. I don't yeah, 5 years. I don't want to oversell and not deliver, so I'll undersell. 5 years, you know. Even though 5 years, within 5 years, we're going to hold for 5 years and sell. Now, sales and marketing. Again, we're going to be using raises.com. They're the ones who are going to get the idea in front of accredited investors and raise the funds for us. $6,000 cost, worth it. Digital marketing, we'll use YouTube, Instagram, uh, we'll just say YouTube Meta. Um, we're going to use the Juniper Investor platform. It's also marketing. We're going to host these events where we could pitch the idea to small groups of people, whether it be medical professionals, people in the finance industry who are license holders, Series 7, Series 65, things like that. It had um, Black military families, veterans, especially the older ones. They do have the wealth. That's where the money's at. Um, And then, yeah, networking and the investor pitch events. That's going to be a big thing for the local base. Even though raises.com is raising the money, they can raise the money. We're going to build a local base of investors because ideally, again, the plan is to uh, acquire the property through syndication, but we are also simultaneously building a REIT. And one of the very important things of why we need to close on raises.com and fund the marketing for this is there is a Black Friday special where we get two raises from one. So they'll be able to raise the money for the REIT and raise the money for the syndication. Why is this important? Well, after we purchase the property through syndication, we're going to have investors who we have to pay back. And logically, this is how our mind works. Well, we could raise $2 million. We should be able to raise 2.5 million, right? So we're raising this 2.5 million, and the plan is to purchase the property with the money from the REIT for the 2.5 million. Make sure we take care of our investors, our limited partners, but then have the property, to us, Akali Acquisitions, have the property to us. It's bigger goals, you know, but we'll go into that later. So marketing activities will leverage raises.com to attract investors, host pitch events and real estate networking functions, showcase authority via YouTube and social media using Meta, partner with Juniper for targeted marketing campaigns, uh, implement a multi-channel approach to maximize visibility and investor engagement. So we're hitting it on all fronts. Then we have a system that we are able to use to verify if people are accredited investors, because that's the main thing we're going to reach for is the accredited investor. We're still looking at filing because there's two different ways we could file under Regulation D, Rule 506, B or C. It is just all depends. If we want to go after accredited investors, we can have a limited accredited investors with general solicitation, but or we could have 35 not accredited investors, people from our community who we know who would like to be interested in this, and then unlimited accredited investors, but there's no general solicitation. So, things that we are planning for. Now, why this property? Again, this is commercial property, meaning that it is currently bringing you money through rents. To the bigger picture, why we want to establish the REIT is because it has special tax advantages, and we have to pass off at least 90% of the income in the form of dividends to our investors. So it's something to help people take care of their nest egg, help people invest in real estate, diversify their funds, but more important, uh, um, this is a greater social project. Now, in the event that a COVID happens, or the economy goes bad, like we're socialists. We believe that housing is a human right. It is not necessarily socialism. This is traditional African ways of thought. Housing was a human right. If you belong to the community, you had a house, you had the ability, the right to work. You had the right to whatever healthcare that we had in the area, mostly voodoo or African spirituality. But being part of the community gave you rights to a dignified life. Everything you needed to have a dignified life was provided to you by your community. So we say all that in the event that things go terribly wrong, uh, we are able to work with our tenants, making sure that we're not just kicking them out on the street, making sure that we're not contributing to high inflation for housing, making sure that people have a place to stay if worse comes to worse. Now, our goal to offset if anything happens, this is what we could talk more about this later, but to offset that hit that we will take if anything happens, we are simultaneously looking at investing in other areas with the REIT. Not as just acquiring properties, we're also being lenders. A REIT allows you to lend to real estate companies, real estate development companies, real estate construction companies, anything having to deal with real estate, we can lend and get that money back. We also have an ambitious plan to acquire properties through um, uh, tax defaulted properties and tax liens. Very interesting stuff. We can talk about that later. But this property right here, $174,000 is what it's bringing in. That's what it's bringing in current, or this is what it can bring in. Now, there's $66,000 in expenses and costs. And that's including the 5% management fee, making sure that everything is running, who we will have for managing the investments, will get a 5% fee from specifically this acquisition that goes into that 66,000. But altogether, that's left over is roughly $108,000, which will be annually, which will be distributed to our investors, to our limited partners. All of that goes to you. These are some of our milestones because we are planning on acquiring this property by January 1st. I know that's what we're pushing towards. That's what we're going to go for. Now, this is Olukun Akali, myself. I will be the general partner for this deal. There may be other partners. We're still looking at how to structure this. Because me personally, this is my passion, but ultimately, I want to build the trust between investors here, is particularly investors in the Black community, and have a record of being able to take care of our investors and our limited partners, delivering on our promises, delivering the desired returns. And once we could do this, we plan on acquiring properties back over in Africa. So I plan on going to Africa. That's me. I'm what do you expect? Blackity black, 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 black. And so there may be other partners to manage the properties here. Even in the REIT, we're not really planning on acquiring, initially more than, a few dozen properties. And that's just initially in the REIT. Because again, a big goal is to transfer investment capital to developing the African financial markets and creating an ecosystem of trade and commerce going to and from the continent, the Caribbean, everywhere else you find Black people with money and anybody else who wants to invest, building our economy, building our community. Now, I'm a emerging real estate investor, and I'm the founder of a BB Soul Business Planner, short for BB 48 Solutions, a BB Soul. BB Soul Business Planners is a business development organization. Now, what we do is help our clients scale their businesses, acquire other businesses, or acquire funding for whatever ideas they have through business planning. We create business plans. And we can talk more about that later. Partners and resources, number one, are commercial property advisors. Commercial property advisors is a commercial real estate advisor firm for investors in commercial, apartment, and multifamily and mobile home parks. They are the ones who are helping us understand commercial real estate, structuring deals, analyzing deals, and a lot that has to do with this process. They are valuable, very valuable. In fact, the skills they taught us through negotiation is what allowed us to get Brock to go down from 2.1 million to 1.85 million. And I know I can get them to 1.75. At capitalraces.com or races.com, they are the ones who are going to be raising the money for us. They will be developing the syndication framework and it's dealing specifically with accredited investors. Now, to be an accredited investor by the SEC, you have to have $1 million net worth, excluding the value of your home, be making $200,000 annually for the last 2 years, single, 300,000 jointly with your spouse, or again, be Series 7, Series 65 license holder, financial industries. So there's unless you have these type of people in your network, and I only have a few, I don't have many, especially for a REIT, you need at least 100 investors for a REIT to be a REIT, to file as a REIT. So I don't have that many accredited investors in my network. So capitalraises.com they're the guys. Natu, doing my due diligence, understanding who the founders are, what the business is about, checking, doing due diligence, because this is an investment of our money too, your money as well, since we are raising money. The $6,000 for the raises.com, we are raising that money. Very important that we do our due diligence. But so they're the ones who are going to be raising the funds for us. And then Juniper Square. which is a system again that enables the general partners and the limited partners to exchange information, understand more about investments, invest, make sure we can get the proper tax informations like your 10Ks and handle the distributions because uh, there will be the income that comes in gets 90% of it gets distributed back to you guys. So there'll be distributions, the 8% preferred return. Now that is it for the pitch deck. That we can jump a little bit into. Let's look at the plan so we can get a little better understanding of the numbers, and then we'll end it by showing you the offering memorandum. So let's just go back to the financial plan. It's the monthly income, 1450 a month. Expenses break down. I think that breaks down to net profit. All right, so this is a more detailed look at what it's going to take, the expenses. Salaries or wages, that's the 5% management fee or the 10% management fee. Employee related expenses, that could be seen as the taxes involved, the payroll taxes, things like that. $7,500 in HOA fees. However, you will notice in this is what I need more clarity on. You will notice in the offering memorandum provided by Access, it says that the HOA fees are reimbursed. I didn't quite understand it, so I just put that there to expect to lose that. So if we get it back, great. But if not, at least we kind of figure we weren't planning on it being there. Maintenance fees, roughly $6,300. Insurance, $4,920. Utilities, $360. The property taxes, which are the big woof, roughly $32,000. And they could increase with the sale, but we will determine that later. Uh, but that gives us a grand total of 66,440 for the operating expenses. Now, in the process of due diligence, will we see things like the maintenance, insurance, utilities, and all of that? We're going to double check because we want receipts. If this is how much you're paying, show us the receipts. We've got to be that detailed. 62% net profit margin. How does that cut off? Sorry about that. Okay, yeah, let's stop sharing real quick. Hey, very handsome. I love the way I look. So we're gonna go in here and we're gonna pull up. Forgive me, forget. Should have had this pulled up already. I know. There we go. So yeah, we're gonna pull up the offering memorandum just to get a quick look at that. Then we're going to go over a little bit more for the investment details, and then we're going to close it out. Let me pull up that memorandum. 1 second, 1 second. I hope you're enjoying the music if you can hear it. So I'll just let the music play so I don't have to do so much talking. This is some Afro lo-fi. CW is loaded up. Let me make sure I got nothing embarrassing up. You never know these days. Mm-hmm. And go back to share screen. Perfect. Now this is the often memorandum. This is 9706, 9718 Southby Plaza. So yeah, initially they wanted $2,100, and if you actually look on the listing now, they put it down to 2,100,000. They put it down to 1,990,000. I got them, and through discourse in the emails, Brock's talking about $1,850,000. I know I could get them to go down another 100,000. You know, let's see. Why is it going so fast? So, welcome to the Southby Townhomes. Meticulously maintained 5 unit portfolio. Again, it's 5 units. The video you showed, we just toured 1 unit. That was an available unit, but there are 5 units altogether. Um, these high-end townhomes feature 3 bedroom, 3 bath, 2 car attached garage, maintenance-free living with HOA covering lawn care, snow removal. Investors seeking to expand their portfolio will find Southby Townhomes a must see. You see, each unit is 1,922 square feet. So, geographic information, demographic information. Townhome highlights. This is another one of the pictures. High end, open floor concept, gas fireplace with a stone surround and plenty of natural light. 2 car attached garage, front and back patio, fenced in yard, on site laundry, maintenance free living with HOA, and easy access to it. You guys don't care about that. So, tenant pays utilities basically. So I think, even when you see in the financial statements where it says, reimbursement, I think this is what the reimbursement is, and it's all figured in the rent. Forced air, washer and dryers, central air, natural gas. Yeah, built 2020, so this is fairly new. By the time we'll purchase this, it's 5 years. So, so again, this is market rent. For the unit that's available, we have somebody lined up to pay market rent. We got 2 other people that would be interested. And because what is it? March next year, this lease is up. All 3 of these are up. We do have 2 people looking to uh, move into these properties at market price. Um, we would still have to review the leases with all the other current tenants, see if they're willing to stay. But 3 out of 2, we got it solved. Some more images. Um, this is what they're currently getting total. This is what we can get. And I know this is what we can get. That's why I used it. I figured it in. That's realistic for us. More information, by schools, elementary, shopping centers. More information, property photos. I think they touched up the driveway on. You see the video how the driveway looked. So that could also be part of the value add. That's something that we are definitely one of the capex expenditures that we were talking about. That's why that $135,000 price is there, just in case it could increase the value if we repaired the driveway. Just touch that up. Backyard, more pictures. I do want to add that property that we seen. I don't know if this is on all of them, but the one that we visited that was available did have like a deck with a balcony on the back. So I don't think every unit has it, but the one that we seen did. So there might be some value add in some of the other properties. We still have to go back and take a look. But this is the financial analysis from the pro forma they sent. The washer and dryer that they have in there, they're charging $175 a month for. Um, and that gives them a little boost in revenues. They say pet rent. I'm not sure who has a pet, who doesn't, but that could also give us a boost in revenues. And then there's that HOA reimbursement. So that's why I was said I'm not sure because you'll see it's the same 7,500. I'm not too sure, if we get that back or how that works, but I just figured that we won't have it. And since we will be demanding I think that it's more beneficial just to demand a higher rent and not charging for the washer and dryer because we make more money in the end when we do that instead of having lower rent than adding the washer and dryers. But yeah, insurance for utilities. See the HOA fees are reimbursed. So there you owe, but there it's reimbursed. So I don't know. And then maintenance. And then maintenance, I think would just be seen as I don't like. I gotta see receipts because it's like I think they're just figuring industry standards. How often are you repainting something? How often are you changing the filters, the furnace filters, things of that nature? So we gotta see receipts. Total expenses they calculated is 45,431.58 cents. Now we calculated as 66,000. So that's a key takeaway as well. We calculated expenses a little higher. You'll see we did 32,000. I know that it's less. Here it's $15,336.26 for the taxes that paid twice a year in March and in August. But we did 32 altogether. And keep in mind that prices will go up. We do believe property taxes will be going up. 6% cap rate. They gave it a grand whopping total of 130,638.42 for net income, and we have it more figured at 108,000. More realistic anyway. Now but again, we're focusing on the value add because the value add will allow us to sell the property. And part of our plan is to sell the property to ourselves. However, we still will look for other buyers, but the goal is to build a REIT, raise the 2 million for this, and raise another 2.5 million to in the form of a REIT to acquire that to take care of our general partners and limited partners within 5 years. All right. So stop share on that. So what do you guys think so far? I mean, post what you think so far down in the comments. Leave a comment. Let me know what you think so far. But we're gonna go ahead and share more of the investment highlights. So let me go back to here. Share. So you get a full visual of what we're really offering and what we're offering our investors and our limited partners, what it all breaks down to. That we do this. This still is just a rough draft, so it's not finalized. There are other things that we got to kind of account for because we're looking at since we're dealing with accredited investors, if we want to specifically deal with investors who can afford a $50,000 minimum investment, or if we, keep it open with, and again, let me just say this document is for informational purposes only. It does not constitute an offer to sell or a solicitation of an offer to purchase any securities. Please review the complete investment documentation for detailed terms and conditions. So we got to say that. But going back, or if we want to do the minimum investment as $1,000, because again, we're 506 rule B or C. Do we want to be able to capture the non-accredited investors, limited accredited investors, 35 non-accredited investors, or do we want to go with all accredited investors? And if we're going with all accredited investors, ask for 50 racks. But either way, let's see. So total equity raised 2 million, minimum investment $50,000. That breaks down to roughly 40 investors. And then if we do a REIT, we need 100 investors. So it's what we're pushing for. Preferred return would be 8% annually. General partner to limited partner split is 10% general partner, 90% limited partner. Profit split after preferred return. Acquisition fee, acquiring 5% of the purchase price paid to the general partner at closing. Projected equity multiple is 1.45x, meaning for every dollar you spend, for every investment dollar, you'll be receiving $1.45 in return. For every investment dollar you spend, you will be receiving $1.45 as return. The IRR is pending. It's still pending. We still have a few calculations we're trying to work out. Um, Figure it out through Excel. Still working on it, so we'll get to that. Again, the whole period is 5 years. The plan is to finish the basements, raise the value, maybe repair the driveway, raise the value of the property, and then sell it for 2.5 million. Hold for 5 years and then sell. Why the syndication? Again, there's the 8% preferred return distributed annually, and since the total net is under for the 8% to really hit, you need to be earning $152,000 for the year. But since we dialed to the $108,000, that annual 8% would preferred return would occur, and you'd be paid out the accrual from the sales proceeds, just to let you know that ahead of time. Um, there's a 90% equity split on profits after preferred returns. And but it also is I should put this, whatever money that we have left over from the investment, the goal is to do things like investing in um, uh, tax defaulted properties and tax liens. Um, so whatever that comes from that, will be distributed to the partners. They'll see it in the preferred returns. We have an experienced GP, myself, and our team. Our partners with Juniper, our partners with Raise Capital, and our partners with commercial property advisors. There's a strong demand for the property. Omaha and the area is booming. There's a lot of jobs there, good paying jobs, medical. The area is right outside of the industrial area, and we have a few people lined up who are interested in the property. The investment structure would be a 90-10 split again. The GP has a 10% ownership stake, responsible for managing operations, distributions, and exit strategy. Limited partners have 90% ownership stake, contributing $2 million in capital. There will be an acquisition fee where we will retain 5% of the property's purchase price, paid to the GP at closing. The LPs, the limited partners, receive an annual 8% return on investment capital before profit splits. Profit split after the preferred profit return, profits are distributed 90% to LPs and 10% to the GP. This is how we kind of figured things out. Now, the cash flow minus the management fee is that $108,000 that we were looking at. This is 115, but when you add in the employee expense, that's why I said this is a draft, because when we factored in everything, let's go back to here. With the employee expenses and everything, it tricked that number off from 115 down to $107,560, which is rounding up to the $108,000. But that's what you add in like taxes. At So there will be a shortfall, uh, since that 182 again isn't hitting. Well, we need to bring in 152 for that preferred return to be able to hit, like where all of the investors get their 8%, and then uh, uh, the profits are shared. But since that is not happening, uh, what happens is that occurs each year for the 5 years, and then after the 5 years, we should have roughly 184,000, which then gets paid to the investors who have the 8% preferred return. That comes out of the sale, so the net proceeds. So after we pay the investors, which were, if we just stick to the accredited investors, all 40 accredited investors. If we're not sticking to accredited investors, if we do the 35 not accredited, they will have the regular shares, and then the accredited investors will have the preferred shares. And the preferred shares would get paid that $184,000 out of the 2.5 million first, and then the 90% that's left over gets distributed to the investors or the partners. Now, when you take in all of the distributions from the cash flow and our exit, we're actually bringing to our partners $2,892,000. So that is quite a return from a 2 million to $2,892,000. That's good money. We pick up pennies, dimes, and quarters on the floor. Uh, when we find it, we pick it up, but we thank Olukun. So I'm telling you, like, why would you leave money on the table, Chief? Again, for every investment dollar you're spending, you're getting $1.45. back. For every investment dollar you're spending, you're getting $1.45 back. For every investment dollar you're spending, you're getting $1.45 back. Be excited about this. Cash on cash return is 5.76 annually. And some of you who aren't as sophisticated, you're like, well, what is 5.76? Look at what you're getting on your bank account. Look at what you're getting on your 401k. And you compare it to that and you tell me where you want to put your money. They're the 8% annual return. So let's break it down so we look at real numbers, especially since we're aim is to deal with accredited investors. So we want you guys to visualize what you're beginning. So for one $50,000 investment, which is one share for a limited partner with preferred returns. Because again, you guys get it now. But annual preferred return would be $4,000 a year. So this is how much you'd be getting, $4,000 a year. So after 5 years, it's $20,000. So profit from exit is $22,500. That's 90% of the net proceeds. So your total return for your investment would be $74,750. That's going to be your total return. So that's your money and then some. That 50,000 back plus the 22,500. Okay, so that is equity multiple altogether of 1.495x. For every dollar you spend, you'll get 1.495x. Key benefits are preferred returns, ensure predictable income, aligned interest. The GP earns 10% share only after LPs receive the preferred returns. So the general partner doesn't get anything until you guys get paid. If you get that's just how it rolls. Transparent compensation again, there is the 5% acquisition fee that we are retaining for sourcing and underwriting, putting this deal together and making sure so you can understand the overall plan. Part of this money is going to be used to stabilize the property in the event that we are not able to find somebody. We want to make sure that there's still money going in the property to get our investors and limited partners paid. We want to make sure our investors and limited partners are paid. Uh, so the process is I don't know if I will, well, we won't show you so we do have a platform that we were using, but again, they didn't align with us. We kind of built out the deal on that platform, but it allows you to, submit your interest to an online portal. So you go in, you create an account, it allows you to view the deal, look at the information, read all the investor information, link your bank account to fund the deal and to get distributions. Uh, uh, So the key takeaway from all of this is we are helping our investors make that predictable income for the nest egg, making sure they have something to take care of them and the family in the event that they're not able to work, have something coming in. You never know. COVID threw a lot of us off. If something like that happened again to where the economy is shut down, investors like knowing that they'll have money still coming in each month. Um, this is just more than math. You can see where the numbers came in. You know, cool stuff to share. So, anyways, again, this is a exclusive syndication deal, even though this is general solicitation. Well, no, actually, this isn't any type of solicitation. This is just giving you the information. But when we do, it's either if we're dealing with all accredited investors, it will be a general solicitation, and then if not, we'll set up meetings and gauge interest and things of that nature to make sure that we're SEC compliant. But this is just to get the information out there, just to see what you guys are thinking. If you are interested, please email us at Alkali Acquisitions, ALKAALI at gmail.com for more information on this investment. We're not accepting anything right now. However, if you want to put in the interest, maybe send a soft commitment. We're not taking any money right now, but this is just to get the information out there. Now, again, my name is Olukun Akali with the BB Business Plans. We are a business development company. We help our clients gain funding, acquire businesses, plan and scale their business for their eventual exit. That is what we do. And this is an idea that came to us from our study into corporate finance, working towards acquiring our Series 7, Series 65 investment advisor licenses, because we understood corporate finance is going to the public, getting money for your businesses. Overall, it helps our clients and BB Soul business planners. And then we were introduced to the idea of a REIT and other real estate investments and developing funds and all sorts of cool things. Going to the public, using other people's money to fund our objectives. And so that's who we are. That's why we're here. And this video is more evidence of why you should support us, why you should want to learn more information about the syndication and REIT. So again, thank you for your time. We look forward to partnering with you. My name is Olukun Kwaheri.